Hello guys to the third lesson. Today we will talk about imbalance. I had drawn some candlesticks here to show you an example. And then we will see an example on real chart. Imbalance zone is usually made when market do an impulsive move. It's a clear candle. This means that candle does not have a wick on the side of the previous and the next candle. This will happen when banks want to increase or decrease the price for their own goals. Imbalance zone will usually happen after a consolidation. You should know what consolidation is because we talked about it. After imbalance, banks will force the price to come back into that zone because they left the money there. If you have demand zone or supply zone above or below imbalance zone, then that is another confluence to enter that trade. Because as the name says, that is demand zone and bank may be interested in it. Because you know there is a demand and also imbalance zone. It's a high probability trade. Look at this. We have the zone which banks controlling. And we have the zone which banks want to reach. They will do an impulsive move and instant goes to it. And of course, after imbalance was made, they left the amount of money that they have down there. And they will sell assets to get it. Now I will give you an example. Imagine you're walking down the street and you see $10 on the floor. And right after that you see $100 a little further away. We would all run first for $100 instead of $10. So, then we would go back for $10. The situation is the same with the imbalance. They will impulsively raise the price to reach a certain amount of money. They will create imbalances, which means they will come back for the rest of the money. I heard this example somewhere and it's really good example. Hope that you guys get it. Write these things on the paper so you will always have it near yourself. Especially when you do your technical analysis. After these theoretical examples, we will go on real chart to find imbalance, and we will also repeat previous lessons. So, be focused. First example. You can see how big this candle is. A big imbalance is made by this candle. After that, price is coming back to cover an imbalance. I didn't saw this chart before this video. I am finding imbalance right now. So, we also have imbalance right there. After price coming back and covering it. Also, imbalance zone right here. Price covered it. And then make retest on supply zone. Here you can see how perfectly price cover imbalance with just a wick. Keep in mind that nothing is 100% in forex. So, we don't always know that will the price cover imbalance. I'm not one of those people who promising you. And I will never tell that something is 100% accurate in forex. In example number 2. We have a downtrend. After a downtrend we see a change of character happen. After change of character, price did reaction on demand zone and made break of structure. After price made break of structure, same thing happen again. So, the question is, where the price reacted again? We have imbalance zone which price will cover. If price also made break of structure like it did imbalance, we can look for buy positions. But, where? That would be this demand zone. This zone is little on this time frame. But on smaller time frame this zone is actually consolidation. So, we have break of structure, imbalance, and demand zone. Enough confluence to take our entry. We will talk about demand and supply zones specially in some lessons, so don't worry. For this lesson you should understand what imbalance zone is. I forgot to mention one thing about this example. And if you already have this imbalance, we also have this bearish imbalance here. So, If we know that we have a bearish imbalance, we also know that it should be filled. And that is another confluence to enter the trade. This is the end of third lesson. I will tell you again to write on the paper all of these things I have told you. Also, you can go on your TradingView chart and find your own imbalance zones. Practice and build your own experience. See you in the next lesson.